The question I get asked the most is, when's the best time to invest? To which I always reply, when you have a spare $1, and I mean it. How much you invest isn't as important as the fact that you're investing at all. It's about starting the habit. But I know what some of you are thinking. $1 won't change anything. Why bother? Well, here's why. $1 invested at the age of 20 over 40 years can turn into nearly $1 million. Yes, a million. With the power of compound interest, even small amounts can lead to serious wealth. Let me explain. Imagine you have a trusty piggy bank containing $100. Sure, it's not life-changing money, but it's a solid start. Instead of keeping it in the bank untouched, we're going to put it to work. We'll invest it in a range of top-performing funds. These aren't get-rich-quick schemes. They're well-established investments that have shown consistent results over time. Our goal here is to diversify. We're talking about spreading our money across different types of investments to reduce risks and maximize returns. We're going to break down that $100 into smaller portions and allocate them across 4 different asset classes. Asset class number 1, stocks. In this case, we're going to invest $30 into an S&P 500 ETF. This fund allows us to own a slice of almost 500 of the biggest companies in the US. It's like owning a little piece of Apple, Microsoft, and Tesla, all with just $30. The rest of the money will be divided between large cap, international, and emerging markets funds. These investments offer exposure to various sectors and geographies, ensuring we're not putting all our eggs in one basket. So where will the money be invested? The answer is everywhere and nowhere, depending on your preference. We're talking about investing in low-cost index funds through Vanguard, Charles Schwab, or Fidelity. These funds track broader market indexes, providing instant diversification. For instance, an S&P 500 fund mirrors the performance of the 500 leading companies in the United States. By investing in these funds, we benefit from the collective growth of these companies without having to manage individual stocks. All we need to do is pick a brokerage account, open it, and fund it with $100. Simple, right? But remember, when it comes to investing, timing isn't everything. Consistency is the real game changer. By investing regularly, even if it's just $100 a month, we can reduce the impact of market fluctuations. Just think about it. If we invest $100 every month for the next 30 years, we could end up with around $1 million. That's because of the magic of compound interest. The longer our money is invested, the more it can grow. And with each passing year, our returns on investment increase. And yes, we can do this with just $100. Don't let anyone tell you otherwise. Now, let's address a common concern. What if I lose money? The stock market can be unpredictable, I admit, but by diversifying our investments and sticking with low-cost index funds, we can minimize the risk of losing big chunks of our money. Plus, investing for the long haul helps us ride out any temporary dips in the market. You see, the market goes up and down in the short term, but over the past 100 years, it's shown an upward trend. So by staying invested, we increase our chances of riding those waves to financial success. You might be thinking, great, but how will I earn money from this? Well, there are 2 ways to earn money with stocks. First, dividends. Some companies distribute a portion of their profits to shareholders, and we can reinvest those dividends to buy more stocks, boosting our holdings and potential future income. Secondly, capital appreciation. As our investments grow in value, we can sell our stocks and reap the rewards. But before you jump in, let's talk about a few things to watch out for. First, fees. We want to keep our expenses low so that more of our money goes towards investing. That's why we're going to stick with low-cost index funds. They typically have expense ratios below 0.1%, meaning we won't have to pay hefty fees that eat away at our profits. Next, taxes. Depending on your location, you may have to pay taxes on your investment gains. It's essential to understand the tax implications of investing so you can plan accordingly. Finally, emotions. Investing can be a roller coaster ride. When the market dips, it's natural to feel anxious. But we must resist the urge to pull out our money during downturns. By sticking to a long-term strategy and avoiding impulsive decisions, we can increase our chances of success. So, what are the next steps? First, choose a brokerage account. Look for platforms that offer a wide range of low-cost index funds and easy-to-use interfaces. Next, fund your account. Start with what you have, whether it's $100, $50, or even $20. Consistency is key. Invest regularly, whether it's weekly, monthly, or quarterly. And finally, review and adjust your investments periodically. Rebalance your portfolio to maintain your desired asset allocation and stay on track to meet your financial goals. You might be wondering how long I've been investing. I actually started my first investment account when I was just 16. Back then, I had a summer job and saved enough to buy a few shares of a company I loved. From that point on, I was hooked. The idea that my money could grow and multiply fascinated me. Over the years, I continued to invest consistently, even when the market took unexpected turns. I learned from both the highs and lows, adjusting my strategies as needed. Today, I'm proud to say that my early start and dedication to investing has paid off. I've built a solid financial foundation that supports my lifestyle and gives me peace of mind. If you're just starting out, don't worry. You don't need to have all the answers right away. The most important thing is to begin and stay committed. Time is your greatest ally in investing, and even small amounts can make a significant difference over the long term. Do you feel ready to take the first step towards financial freedom? Remember, the journey of 1,000 miles begins with just one step. And when it comes to investing, that first step could be the most rewarding one you ever take. If you found this guide helpful, please hit the like button below. If you haven't already, consider subscribing for more insights into smart money habits. Thank you for watching, and until next time, happy investing!